Alrighty. Hi, everyone. My name's Alex. I'm the co-founder of Kashcade. We're a non-dilutive capital provider to growing tech companies in Australia. Thanks for joining us. We're going to be talking about alternative ways of funding your company, primarily with non-dilutive capital. So any other way as outside of giving away equity in your company. I just want to start by saying that what we're talking about isn't financial advice. It's simply based on what we know and what we see in the market. So please take everything with a grain of salt. I'd like to start with these two images. So a lot of you are probably familiar with both people, both companies. So on the left, we've got Steve Jobs holding a check, and on the right-hand side, we've got Phil Knight of Nike. I'm a fan of both companies, both founders. Both of them listed on their relative stock exchanges in 1980 within 2 weeks of each other, and they're both mega success stories. The real difference between them, though, is quite important. So Steve Jobs, he sold a third of his company for a $250,000 investment from Mark McCullough. You can really tell that the smile on Mark's face on the right-hand side is much bigger than the smile on Steve's face on the left-hand side. So this is actually quite similar to what we see today. A $250,000 check back then is probably equivalent to around $1 million today. And where companies are raising seed rounds, pre-seed, they might raise $1 million on a $2 or a $3 million valuation. It's not uncommon to see something like that. Phil Knight, on the other hand, he used non-dilutive capital all the way until IPO. So he did not sell any part of his company throughout that whole stage. So although both had really good outcomes for their businesses, for themselves, there are very different ways to go about raising capital. One might leave you with about 10% of the company. The other might leave you with a majority. For most businesses that aren't going to be the most valuable company in the world at some point in time, it's even more important to consider how you're funding your company and how much equity you're giving away at each point in time in your capital raise. So what is non-dilutive capital? Pretty simply, non-dilutive capital is where you're not giving away any equity in your business when you raise capital. So what is dilution, that component of it? Dilution simply refers to the reduced equity stake you have in your company or shareholders have in the company once they bring in new shareholders. Mainly this comes from venture capital investments, angel investments, but it also comes from things like convertible notes or safe notes you probably heard of. Those are two things that give you money today and then ultimately convert into equity in your company later. They also come in the form of options or warrants. Options and warrants are pretty similar to each other, but basically they're the right for someone to buy equity in your company in the future at a price that's agreed upon today. So all these things lead to someone else taking ownership, some piece of ownership of your business. With your typical fundraise from a VC or a normal kind of round like we're used to, there's around 20% dilution each round between your pre-seed and your Series D, thereabouts. And then from there, as your company matures and becomes more and more valuable, there's less dilution each round thereafter, but it's pretty material. So non-dilutive capital then is, as we were saying before, where you don't give any piece of your business away. So instead, people give you capital and you pay them back over time with a premium, or there are simply programs out there to incentivize your behavior whereby they'll basically just give you money to incentivize you to do something. So we'll go through the different types of these. Mainly, though, these three are categorized in different areas. So grants and rebates is one. People often forget that this is a type of non-dilutive capital. It can be factored into your capital raising strategy. But pretty similarly, I'm sure you're all familiar, it's where you get cash rewards or you get a refund based on some behavior or activity or industry that you're spending and building a business within. The second is revenue-based loans. So these are loans, as you know them today, that are given based on how much revenue you're doing or you're expected to do. And then the third category that we'll talk about is where you can pre-fund some future income. So you're expecting to receive some income in the future. You can actually bring that forward to today and receive some portion of that so that you can start spending that. So the first, grants and rebates. Grants and rebates are really good for working capital or program or area specific sort of activities. They're typically only available in certain points of the year, like for example, after financial year. But they can do a whole range of things for you. Grants, they're referring to funding in advance of you spending something. A very classic one that we see in this market here is the Export Market Development Grant. That basically gives you 50% back on your eligible marketing or lead generation spend, where you're expecting to try and export your product overseas. Rebates. So rebates are simply a refund on some portion of money you've spent to date. And the most common one we see in this market is the research and development tax incentive. That's where you get some portion of your money spent back based on your research and development activities throughout the year. So for a lot of companies, they get 43.5% back of their research and development spend throughout the year. And again, that happens at the end of financial year once they lodge their tax return. That's pretty material, and it's very common across a lot of tech companies and companies working on novel things. Matched funding is slightly different. That's where someone will give you an amount of money on top of money that you have raised elsewhere. We typically see it $1 for $1, or someone will give you 50 cents for every dollar you raise elsewhere. The suitability of these different types of grants and rebates and programs really aligns to what the program is all about. So whether it's industry specific, whether it's activity specific, you're thinking about the timing of when you can receive that money will all kind of factor into how you think about using these capital raising options and what you can do with that money. So a classic example, like we were talking about the Export Market Development Grant before, you can get $50,000 back if you've spent $100,000 on overseas focused lead generation activities. And you can get that at the end of financial year once you lodge your tax return and you've made those claims. There are a whole range of grants and rebates available from the Australian government and broader organisations. A good website is just down below. I recommend everyone check that out. You can search by industry, by activity, by whatever the area of business that you conduct in. The second type of non-dilutive capital is a revenue-based loan. So these are loans provided based on how much revenue you're doing at the moment or you're expected to do in the future, and they're repaid over time with a premium. So because they're repaid with a premium, they're really ideal for activities that are going to generate some sort of return, whether that be a specific growth initiative or just when you're going through a phase of growth. But you really want to be thinking about generating more of a return than the premium you're about to pay for that loan. So what we typically see in a revenue-based loan is the amount that you can actually get access to is based on how much revenue you're doing. This is often around, we see up to a third of your annual revenue. And it comes with either a fee and or interest that's either repaid upfront or over time throughout the life of the loan. Repayments, they can be fixed or they can vary periodically. So whether you agree to repay a fixed dollar amount or whether you agree to repay some sort of percentage interest rate based on how much time the loan was actually outstanding. And these repayments can be daily, they can be weekly, they can be monthly. It can really vary just based on the type of business you are, the type of loan agreement you're entering into, and what kind of provider you're working with. So for example, where we're working with software companies that sell multi-year contracts or single-year contracts to other businesses, they might get a 12-month term loan. And so they might commit to a monthly repayment of some equal amount over the next 12 months. Whereas an e-commerce company might enter into a 3-month loan agreement whereby a fixed percentage of their daily turnover is sent back to make repayments on the loan over the next 3 months. So it really can vary. Of course, because this loan is based on the revenue, these kind of loans are really only suitable for those companies generating revenue. Typically, we see the starting points at around $300,000 to $500,000 in annual revenue. A lot of the time that's looked at over the last 12 months. Some cases it may be looked at the current month or the last 3 months, and then forecasted forward on that basis. The reason it's around $300,000 to $500,000 is the starting point for a lot of providers. It's because you want to have some sort of momentum in your business. You want to have some sort of spread of customer concentration across your business so that you're not going to be vulnerable to some large customer dropping out or a period of highly volatile revenue, which will make it difficult making those monthly or periodic repayments that you've committed to. So the most classic example would be, like I was talking about before, a software company that's doing around $1 million in annual revenue. They might want to access $200,000 or $300,000 in a term loan. The ideal payback period for them might be 12 months because they might want to spend that money on hiring a new sales resource or spending on a marketing initiative where they're going to start to see a return on that spend in the next 3 or 6 months. So paying the loan back over 12 months gives them time to actually see that return come back to them. They might pay for this 12-month term loan a 15% fee on the $200,000 they borrow. So they borrow the $200,000, they get attributed a $30,000 fee, and they repay $230,000 divided by 12 over the next 12 months. So around $19,000 a month for the next 12 months. So that brings us to the third category, which is pre-funding future receivables. So these are things like invoices, grants, rebates that you can bring forward to today if you know they're highly probable in some point in the future. So when you're actually given a pre-funding of your future receivable, it's typically going to be only up to a certain proportion of that future receivable. So we often see providers willing to fund up to 80% of that future receivable. So for example, if you have a $100 invoice that's due in 60 days, someone might be willing to give you $80 today. The cost structure is pretty similar to revenue-based loans. There can be fees, there can be interest, some combination of both, one or the other, but it's typically based on how much funding you actually take from the provider. The repayments vary, particularly from the revenue-based loans, whereas these repayments typically happen in one single bullet, is what it's called. So one single repayment at the end, and it's tied up with when that future piece of a receivable actually lands. So again, coming back to that $100 invoice, if it's due in 60 days from your customer, you funded against that invoice, it might be paid back in 45 days. And so at the 45-day mark, that invoice comes in and the loan is paid off. So it really ties to that and aligns with that nicely. The loan lengths we see on these things, they can be very short, they can be less than 30 days, but typically we see a category of kind of 1 to 3 months for when you're pre-funding a receivable from a customer, or with grants and rebates, or longer sales contracts that you have with a customer, they can be up to 12 months or even a little bit longer. So this kind of non-dilutive capital solution is quite suitable for companies with contracted or very highly probable sources of future income. Like, for example, those grants that you get every year, or a sales contract that you've got locked in and you've been receiving revenue against for some time. One of the most common pre-funding of rebates we see at the moment is against the research and development tax incentive rebate that we were talking about a couple of slides ago. So in this case, someone might know that they're getting a $200,000 rebate at the end of financial year. they may want to fund 80% of that now, so they can actually access $160,000 now in the form of a pre-funded rebate, and then it's repaid in full in, say, 6 months' time when they actually get that rebate. So they might end up paying about 8% interest on that 6 months later when the rebate's actually paid into their account. So in terms of use cases amongst the three, it's really helpful to think about aligning the non-dilutive capital type with when you can access it, whether you have to pay it back, and whether that payment comes at a premium, when any repayments have to be, or whether that money has to be spent on something specific, like in the case of a grant. So grants and rebates, they can be slightly more nuanced and specific, and therefore the purposes might be that way too. So because these grants and rebates often align with some sort of industry or type of spend, they have a criteria associated with them, then of course you have to stick within those bounds. Or if they're only available at certain points throughout the year, like the end of financial year, for example, then it might be only something that you can use at that point in time. So we often see people use these grants and rebates for continued product development, for those research and development rebates, or they're just kind of lumped in for general working capital purposes to extend someone's runway because they're restricted to only getting it after end of financial year. And therefore it's harder to time up with other initiatives. Revenue-based loans, they're a bit more diverse in their use cases. They can be used for most things, but you do really want to consider how they have to be repaid and at what cost and when. Therefore, most of the time, you really want to be generating some sort of return on the money that you actually spent with those loans. So you want to turn $1 into $1.50 because you're going to be paying 15 cents in fees or interest. You also want to consider how quickly those funds will generate a return versus when they have to be paid back. So like I was talking about before, a marketing initiative might generate a return in 3 months. And so that works well for a 12-month repayable loan. Whereas something like new product development might have a much longer time, even multiple years, to see a return on that spend. And so perhaps it might not be as suitable for that kind of case. And then with pre-funding receivables, what's really important here is that the repayments are typically taken care of by the receivable. So when the receivable comes in, it pays off the loan. So it gives you much more flexibility in not having to think about a periodic repayment. You can typically access them any time throughout the year. And so it really gives you probably the most flexibility in what you want to be using those funds for. But just taking a quick swing across the top there, you can see that on the left-hand side, we've got a lot of growth-oriented use cases. And then it starts to get a bit more diversified across the right-hand side, which is typically catered towards the nuance of your company, whether your strategy or what's going on at the time. So just talking about some actual use cases that we've seen at Kashcade. So talking about the research and development tax incentive, again, this is one of the most common rebates we see people utilize. A space tech company we saw and spoke with, they're actually pre-revenue. They spend about $500,000 on research and development activities, or they had throughout that previous financial year. So at the end of the financial year, they went to claim that rebate. They're able to get 43.5% of that back. And so that landed them a $218,000 rebate in August. So July came around, they were very quick to lodge a tax return, and about 2 months later, they were able to access that capital. They used that $218,000 then just to continue doing what they were doing, basically just reinvesting into research and development activities and other kind of general purposes because it gave them some working capital flexibility. Revenue-based loans. So a revenue-based term loan is something that Kashcade most frequently provides. Again, this is where you're agreeing to repay funds over a certain period of time. It's all divided defined, and the amount of funding you can access is based on how much revenue you're doing at the time. So one of our customers is a $1 million ARR SaaS company. They were seeing traction after they recently launched into the US. So they'd gone there, they'd tried it, they'd established a bit of a foothold with a cornerstone client. They were starting to see more interest. And so at that time, they saw the potential to really grow their business. They thought they could grow that part of the business at least 25% over the next 12 months. And so they came to us for a $200,000 loan, so 20% of their ARR. That allowed them to bring on another salesperson over there and facilitate some of the expansion costs into the US. And over the next 12 months, they increased their revenue 30%. So they generated a return in that case of another $300,000 in ARR, which was net new. So they would have paid about a $30,000 fee, and they were able to generate $300,000 in net new ARR. So they got about a 10x return on the premium they paid for that loan. A pre-funded R&D tax incentive rebate example was with another space company, actually, that was also pre-revenue. Just to align the numbers though, so we can say that this company had spent $500,000 or would normally spend $500,000 throughout the financial year. But in December, halfway through the financial year, they'd only spent $250,000. What they wanted to do was they wanted to pre-fund that portion of their spend. They knew that they could get some portion back at that time because they'd already spent $250,000. So they were able to access another $85,000. They were able to spend that throughout the same financial year on R&D, so they could increase their R&D spend for that year. And then because they spent more by the end of the financial year, their next rebate was actually 17% higher than it would have otherwise been. So that's a really classic use case. That's one of the best and most valuable situations we see with people pre-funding, really to get a compounding effect. So just before I wrap up, I like to put a bit of a slide together of all the things that we typically see people not realize, and throughout the conversations they have with us, they give us oh, I didn't think of that. So the first is when you consider non-dilutive capital for part of your cap raise, it doesn't have to be mutually exclusive from dilutive capital. People are often coming to us and end up raising, say, 80 or 90% equity and 10 to 20% in debt, some form of loan. That's a really great case. People, their kind of immediate thoughts are, should I raise equity or non-dilutive capital? But really think about how you can factor in a blend of the two, whether it's for a cap raise specifically or whether it's throughout the year. The second is people typically try and access non-dilutive capital. This is more relevant for some sort of form of loan or when you're pre-funding a receivable, but they leave it too late. They're running out of runway. They're in a really tight spot. And then for a lender, that's basically too risky to engage in. And either they have to offer them much tougher terms so you can access less money for a higher cost, or they're just not able to provide funding at all. So really being proactive is going to help you get the best terms and make sure you can secure as much funding as you might need. The third one is how people actually record these grants and rebates. Some people record them as revenue or as part of their operating income. They may factor that into when they're talking to equity investors. And then when it goes into diligence and the investors discover that revenue is not actual revenue, as a rebate, it was a grant of some sort, that creates a bit of friction and typically leads to either falling through deals or a revised valuation or a revised agreement of some sort, and can be quite a kind of sorry story for both sides. So yeah, really thinking about how you record these. Of course, speak to your tax agent and they should be all over it, but not factoring it into when you're talking about revenue is really important. And then the final one is my favorite one, and like I was just talking about in the last slide. When you have a rebate that's based on your spend throughout the year, if you can pre-fund some of that rebate ahead of time and then spend that money on more of those eligible activities, you can actually increase the size of your rebate that you receive in the future. This is a big one. A bunch of people are aware of it, but if you're paying interest or fees on pre-funding, that's typically well taken care of by the increase of rebate size that you end up getting. But they're kind of my top tips. So short and sweet, that's about it. I hope that was comprehensive. If you have any questions, please feel free to pop them in the chat now. You can always reach out to me directly. My email is available on our website. You can check out Kashcade through this QR code or our website as well. We offer various types of non-dilutive capital. We're always open to a chat, whether you think you're ready for it or not. We more than enjoy speaking to people about how they might plan for this in the future. I'll just open up one of the questions that's come through. So the first question is the availability of non-dilutive capital affected by the economic climate? So this is an interesting question. Over the last 12 or 18 months, as we saw the kind of tech wreck happen and equity valuations really reduced, venture capital started to dry up and slow down. This actually made non-dilutive capital a much more attractive option, particularly in the case where people were about to raise capital, they're about to go back to their investors for a new round. They wanted to speak to a non-dilutive capital provider to get a conditional offer that says, if I raise this, we will be able to access additional non-dilutive capital. So a classic one is people come to us, they say we're raising a round, we say, okay, if you raise 500,000, we'll give you an additional 300. So speaking to people's investors and saying, hey, if you guys give me 500, we can get a total of 800. That's a really attractive proposition and something that's become quite commonly used. The next question is from Vincent. So do you find trust structure or foreign ownership structures on top of a proprietary limited causes issues with capital raising or other types of funding? So it's a good question. It's definitely context dependent. I think that's probably the short and sweet answer. It's context dependent. So when it comes to corporate structures, we see all kinds of things. We typically see foreign entities within the corporate structure. The top ownership company can cause some effect on the eligibility, particularly for grants and rebates. There's often a question around where does a majority of the ownership lie and where does the ultimate ownership lie. But it is really context dependent. So we've definitely funded companies through Kashcade that have a foreign parent company, but they've got an Australian subsidiary that reports to and pays taxes to the ATO, and we can work with that. But sometimes it does affect your eligibility for grants and rebates. The next question: are there any tax implications or other financial considerations startups need to be aware of when securing non-dilutive capital? Tax implications. So again, I'm not able to provide advice. It'll really depend on your own situation. A lot of the time, though, the premium you pay for some of these funds is a tax deduction. So if you've got a profitable company, if you pay fees or interest for the loan, typically that is something that's tax deductible, as it is an operating expense for your company or a financing cost. Outside of that, it really does depend on the situation and the nuance of that business. Next question is, are there any industries specifically that are more likely to benefit from non-dilutive capital than others? So industries I would mostly tie to the grants and rebates that would be most affected by the different types of non-dilutive capital available. So companies that Kashcade typically funds, we're not necessarily industry focused, we're more business model focused. So when we're looking at providing a term loan, we really look for highly predictable business models. And so recurring revenue contracts, whether they're paid monthly, quarterly, in arrears, in advance, that's all factored into it. Less so the industry. That's just speaking for us, though. I think other providers might really know an industry well and have therefore catered their non-dilutive capital solution to that industry really well. But outside of that, I think it's pretty agnostic. How can startups prepare their financials and other documentation to increase their chances of securing non-dilutive funding? So this is a good one. We often see companies come to us and come to any sort of financier where they haven't fully reconciled their accounting. So their profit and loss, their balance sheet might not be up to date. It might be not so clearly defined, so things are all rolled up into one category, and so therefore it makes it very hard to understand a company's cash flow, a company's current position, and therefore just slows down the whole process. And so we always say to people, make sure when you're ready to actually go through the process, make sure your accounting system's up to date, everything's reconciled. You're able to provide these things in a pretty concise and simple manner. It makes it easier for us to look at. It makes it easier for us to explain back to you why in a non-dilutive capital solution might be a certain way. And then most people will typically require it anyway as just a kind of table stake. I think maybe one more point on that one as well is companies running out of runway love to try and find non-dilutive capital at the last minute. And so just making sure that it's not a last resort capital solution. It'll make it very hard to actually access non-dilutive capital in the form of a loan or pre-funding something if the company looks like it's about to run out of money. Even if there are term sheets on the table from investors, even if there are large revenue contracts coming in soon, it just makes it a lot more difficult to get people's risk committees, investment committees over the line in that case. So we always recommend people be as proactive as possible, start the conversation early, and make sure you don't leave it to the last minute. Alrighty, well, looks like they're all the questions in the chat for the moment. Like I said, please always feel free to slide into my DMs on LinkedIn. Go reach out to us through the website. There's a good funding calculator on there for a term loan. We're always available to chat. We always love speaking to people about what their plans look like in the future and how they might be able to consider non-dilutive capital solutions for their capital strategy moving forward. But outside of that, thank you very much, everyone, for joining, and look forward to doing it again soon.